Get ready for some tax talk, folks. The IRS has just released the new federal income tax brackets and standard deductions for 2026, and there's a lot to unpack here. Let's dive in and explore the changes that could impact your wallet. First, let's tackle the concept of bracket creep. This sneaky phenomenon occurs when inflation pushes taxpayers into higher income brackets, even though their purchasing power hasn't improved. The IRS aims to prevent this by making adjustments to the tax brackets each year. For the 2026 tax year, the top federal income tax rate of 37% will kick in for individuals earning over $640,600 and married couples filing jointly with income exceeding $768,700. But here's where it gets controversial. Some argue that these thresholds don't account for the rising cost of living, potentially leading to an unfair tax burden. What do you think? Moving on to standard deductions, these are also on the rise. Married couples filing jointly can claim $32,200, a welcome increase from $31,500 in 2025. Single taxpayers can now claim $16,100, up from $15,750, and heads of households will have a deduction of $24,150. These adjustments provide some much-needed relief for taxpayers. Now, let's talk about a potential tax break for seniors. Under the One Big Beautiful Bill Act, individuals age 65 and above can claim a temporary deduction of up to $6,000 until the end of 2028, provided their earnings are $75,000 or less for individuals and $150,000 or less for couples. This could be a significant boost for retirees. Despite the ongoing government shutdown, the IRS has assured taxpayers that they should continue filing as usual. A spokesperson emphasized that the lapse in federal funding doesn't change tax responsibilities. Understanding your tax situation can be complex, especially with progressive taxation. In the U.S., tax rates increase as income rises, with 7 brackets ranging from 10% to 37%. Let's consider an example. A married couple earning $150,000. After subtracting the 2026 standard deduction of $32,200, their taxable income is $117,800. They fall into the 22% marginal tax bracket, but their effective tax rate is lower thanks to the progressive system. And this is the part most people miss. The effective tax rate is what truly matters. It's the percentage of your income that goes towards taxes. In this example, the couple's effective rate is 13%, which is calculated by adding up the taxes paid in each bracket. So there you have it. The IRS has made some adjustments to the tax system for 2026, offering relief to taxpayers. But with progressive taxation, it's essential to understand how these changes affect your specific situation. Stay informed and don't hesitate to seek professional advice if needed. What are your thoughts on these tax changes? Do you think they provide enough relief, or is there room for improvement? Let's spark a discussion in the comments.